Hello, everyone. Today we're going to continue looking at Secure Trust Bank. It has been quite a bit of a break since I since my last episode. Been a bit busy with things, but let's just get this screen up. But yeah, today, so in the previous episodes, we went through and had a look at all the different segments, one by one, the four key segments, and then the five if you include the savings as well. Um, Now, this week we're going to continue on to have a look at the sort of the meat of it, which is going to be the overall company financials and then sort of investment thesis at the end. I will just mention we've had some progress since our last just current events. Had some progress with the car finance scandal ruling stuff uh, in the last week, which was that the Supreme Court has um, basically said that Close Brothers and I think it's Rand National Bank, or whatever the two banks in defendants in the previous case, uh, they've been given permission to appeal at the Supreme Court, so that's going to be elevated up to there. So there's still now a chance that things could be overturned, that previous ruling could be overturned, or there could be some alteration made to the decision. So yeah, it's good that it's still moving in the in a positive direction there. It hasn't just been underlined and yeah, that's the ruling and so on. But anyway, let's move on to let's start having a look at the financials now. So start off with income. So the net interest income has grown modestly over the last 5 years from £145.4 million in 2019 to £167.5 million in 2023. Over the same period, net interest margins have fallen from 6.46% to 5.40%. Um, yeah, I'll just say, I mean, I think I'll probably talk about it a bit more later on, but these margins shrinking has largely been to do with the fact that they've been able to, that the interest rates have risen over this period, and they've not been able to pass that on in time. They've had that's obviously increased their funding costs, their deposits, interest on their deposits they're having to pay. Uh, but they haven't been able to pass all of that on to onto their borrowers. So that's part of it, and also a shift with the higher risk default that some of that creates. They've had a shift more to lower the risk of some of their lending. So you've seen this in the retail finance with the shift towards interest free um, finance, which generally has lower margins than interest bearing. But yeah, let's just kind of just bear that in mind. So this includes the figures for a number of operations that have since been discontinued. If you take them away and look just at the continuing operations, the net interest income has grown from 133.5 million to 167.5 million, while net interest margin has fallen from 6.54% to 5.40%. So yeah, a bit more of a rise if you take out the discontinued one. So adding in the net fee and commission income gives us the operating income, which has grown from 165.5 million pounds to 184.7 million pounds over this 5 year period. It's notable that the top line impact of the pandemic and subsequent inflationary shock has been relatively minimal due to lending growth offsetting decreasing margins. The picture becomes a little less smooth when you add in the net impairment charge and gain/losses on financial instruments to get risk-adjusted income. The trough for this figure, 111.7 million pounds, occurred in 2020, and the peak, 161.5 million pounds, in 2021. As impairment provisions made at the onset of the pandemic were unwound the following year. So you can see this here between 2020 and 2021. Risk-adjusted margins were similarly moved by changing impairment charges, but the overall risk trend was downwards. Sorry, the overall trend was downwards in the risk-adjusted margins, much like the net interest margins. If we look at the risk-adjusted income by continuing segment, it's clear that retail finance has been the largest contributor, while the ranking of the other three segments has changed from year to year. Yeah, the retail finance down here at the bottom. This has been it's grown about 50% over that period. The income is, and it's been vehicle finance has been quite variable. Real estate finance has been fairly steady over that period, and then yeah, it's been a bit variable as well with the commercial finance. Record year being twice the smallest year or the lowest year, but crucially, all of them have actually generated a positive risk-adjusted income. Despite CPI inflation having totaled more than 20% from 2019 to 2023, operating costs have kept pretty well in check. The cost-to-income ratio remains between 55 to 58% in all years except 2021, when I'd presume COVID measures created additional costs. So yeah, you can see a little spike there, but they brought it back down in 2022, and then it's risen in line with their overall income in 2023 to still stay below that. And I think we'll get onto it in a bit, but I think they're targeting a cost-to-income ratio of something like 45% when they're fully scaled up, which is again about the £4 billion book value mark. No, that wouldn't be book value, sorry. £4 billion loan book. Part of these cost controls are owed to the fact the company has shrunk its average employee count from a peak of 1,021 in 2020 to 879 in 2023, with the business disposals over the period no doubt contributing to the reduction. Net profit has been positive in each of the last 5 years, but has fluctuated quite considerably, with a peak of £45.6 million in 2021, when the impairment charge was lowest, and a trough of £15.4 million in 2020, when the impairment charge was the highest. 2023 was also relatively low, despite having the second highest risk-adjusted income, due to exceptional items, including £4.7 million related to the FCA's Borrowers in Financial Difficulty Vehicle Finance Collections Review, BIFID. The return on average equity, ROE, has moved largely in line with profit, though, as you can see, the figure in 2022 was lower than in 2019, despite the profit being higher. This is due to equity having grown with retained earnings. As we'll get on to later, they have been retaining quite a lot of their earnings and not paying them out in dividends over the last few years, because they're trying to grow their overall loan book to get a better operational efficiency and get to raise their return on equity up to around about the 15% mark consistently, which is yeah, that's their medium-term goal. As you can see, they only did it. It was only around that level in 2021 so far. So yeah, that's earnings. Let's move on to the financial position. So start off with equity. The total equity has grown from 252 million pounds to 344.5 million pounds over the last 5 years. As alluded to above, this was almost entirely driven by retained earnings, which have grown from 162.3 million pounds to 254.8 million pounds, while the share capital and share premium have risen only minorly due to share-based compensation. This was also after paying a dividend in every year except 2020. Next, we'll have a look at loans and advances to customers, or the company's loan book. So the earnings retained have supported 35.3% growth in the company's loan book from 2,450.1 million pounds in 2019 to 3,315.3 million pounds in 2023, mostly weighted towards the last 2 years. Breaking this down by continuing segment, we can see that while they all grew, retail finance did most of the heavy lifting and helped take consumer finance, which is the retail and vehicle finance segments, from 45.5% to 51% of the continuing loan book. You can see this here in this graph. So the real estate finance has also grown, which has stopped the ratio getting too skewed towards the consumer finance segments. But yeah, it's almost, it's not quite, but it's not far off doubling since 2019, the retail finance segment. But yeah, all segments have grown their loan books, though there has been some fluctuation, as you can see with vehicle finance, for instance. Loan to deposit and funding ratios. Over the last 5 years, the loan to deposit ratio, calculated as loans and advances to customers divided by deposits from customers, has ranged between 115.44% and 121.27%, while the funding ratio, calculated as total funding divided by loans and advances to customers, has ranged between 107.40% and 112.52%. The general trend has been for a growing proportion of loans to be funded by customer deposits and growth in the overall level of funding to exceed that of loans and advances. All else equal, you'd expect the former trend to be positive for return on equity. Yeah, I've got this one in a table this time instead of a graph. You can see the downward trend in loan to deposit ratio and the upward trend in funding ratio. Regulatory capital requirements and ratios. So regulatory common equity tier 1 or CET1 capital of £337.9 million at 31st of December 2023 is slightly lower than the shareholder equity figure due to the exclusion of intangible assets and foreseeable dividends. In addition to CET1 capital, STB has Tier 2 subordinated liabilities forming part of its capital structure and supporting lending. The company issued £90 million of 10.5-year, 13% fixed rate callable subordinated notes in 2023, replacing £50 million of existing notes issued in 2018. This is on the face of it a very high interest rate, exceeding the return on equity in all but one of the last 5 years. It's a fair question, therefore, why issue these notes rather than just continue to build up equity through retained earnings? The answer from management is that it takes them more rapidly towards a scale at which they expect to generate sustainable return on equity in the range of 14 to 16%. I'll discuss this figure in the context of the company's broader midterm targets later. As per the Prudential Regulatory Authority, or PRA, rules, Tier 2 capital of this kind cannot contribute more than 25% towards the Pillar 1 and 2A capital requirements. With a total capital requirement of £238.8 million at 31st of December 2023, the maximum Tier 2 capital contribution was £59.7 million. This leaves some additional headroom for growth. So yeah, there's still about 30 million of headroom there. Before they'd need to raise any more external Tier 2 capital if they want to maintain this ratio, that is. Over and above the total capital requirement, there is additionally a capital conservation buffer and counter-cyclical buffer set by the PRA in line with the current macroeconomic environment. The capital conservation buffer has been held at 2.5% of total risk exposure since 1st of January 2019, while the counter-cyclical capital buffer was lowered to 0% during 2020 and 2021, before being raised to 1% in December 2022, and then 2% on the 5th of July 2023. Dividing the CET1 and total capital, which is the CET1 plus the Tier 2 capital figures, by the total risk exposure of £2,653.4 million at 31st of December 2023, calculated on a risk-adjusted basis, we get CET1 and total capital ratios of 12.73% and 14.98% respectively. Which you can see for the last 4 years in this table. So let's now move on to liquidity. The company is required by regulators to maintain sufficient liquid assets to cover 30 days worth of net cash outflows. The liquidity cover ratio, or LCR, is a measure of these 30-day net cash outflows as a proportion of the company's high-quality liquid assets. And in 2023, it averaged 208.0%. Total liquid assets have grown from £170 million in 2019 to £400.2 million in 2023, in line with not only loan book growth, but also the growth in access deposits, which can be withdrawn on demand. At 31st of December 2023, the contractual undiscounted cash flows for financial liabilities can be analysed by maturity as follows. Got another table here. As you can see, there was £1,578.9 million due within the next 90 days, £834.3 million due within 90 days to a year, and £1,170.5 million due within 1 to 5 years. The £408.4 million due to banks relates to the TFSME funding from the Bank of England, which, as previously mentioned, will be replaced with new customer deposits before it falls due in 2025. Next, we'll have a look at credit risk. So STB's credit exposure is divided into 3 stages according to the following classifications. Stage 1, loans deemed to have low credit risk or that have as yet shown no indication of default. Stage 2, loans that have experienced a significant increase in credit risk since their initial recognition. There's the possibility for a loan that has moved to stage 2 to be cured and return to stage 1 if the credit risk improves. We have stage 3, which are loans that are credit impaired or have defaulted. Once a default has occurred, the loan cannot move back to stage 2 or stage 1. It should be noted that the fact a loan has become credit impaired or has defaulted does not necessarily mean the funds will not be recovered, as in many cases collateral is held against such a default. The company's credit exposure at 31st of December 2023 can be broken down as follows. So we've got in this table, we've got a breakdown of the different segments: retail finance, vehicle finance, real estate finance, commercial finance, with across the other axis, breakdown of the stage and the total gross exposure across them all. So at the and then we've got the impairment allowances applied to each stage as well. And since most assets are in stage 1, we've got a higher impairment allowance on there, but relatively higher, as a proportion to the total drawn exposure in stage 3. Well, yeah, sorry, stage 3 is the largest because that's all assets that are actually already in default. At the year end, 4.5% of total drawn exposure was in stage 3, and 8.8% was in stage 2. As you can see from the graph below, this is pretty well in line with the levels seen in the last 5 years. Similarly, with total impairment allowance, where other than in 2020, when increased allowances were made at the outbreak of the pandemic, the overall level has moved pretty well in line with drawn/gross exposure. That said, there was a notable increase in the proportion of the total impairment allowance allocated to stage 3 loans in 2023. Oh, excuse me. If we look at the segmental breakdown for 2023 below, we can see that vehicle finance makes up over half of the total stage 3 allowance. Historically, it has had the largest share, but even so, the current level is markedly high, reflecting the impact higher interest rates having on loan affordability for near-prime customers. Collateral held against these loans is also of a lower quality than used in the business finance segments, meaning a greater proportion of defaulting loans result in credit losses. Real estate investors and developers are being similarly impacted by high rates, with 9.6% of accounts classed as forborne and 7.3% of loans in default at the 31st of December 2023. It's testament to the strength of the collateral that despite this, provisions held against expected credit losses remain just 0.64% of gross loans and advances, or £8 million. However, this is still above historical levels, likely indicating that development loans with lower collateral are suffering defaults. Retail finance is showing pretty normal levels of impairment expectations, illustrating the rigor of the credit selection process and the benefits of predominantly offering interest-free finance. And finally, despite a relatively high impairment charge being recognized in the income statement for commercial finance, the forward impairment expectations remain low, with provisions of just 0.55% of gross loans and advances held against losses. So I've got this laid out in this graph here. Want to underline the fact that impairment allowances/provisions are generally above the impairment levels actually experienced in any single year. This doesn't discount the possibility of unexpected losses above this level, as seen in 2023 with the commercial finance, but it does mean on average they should be significantly lower. As the loans and advances figure shown in the statement of financial position has already had these impairment allowances deducted, future credit losses also shouldn't impact shareholder equity. So, yeah, the when impairments do occur, they're taken first out of the impairment allowance, and the impairment allowance has been built up by prior charges uh, ahead of time on the income statement. So it won't affect earnings, but obviously there will be a cash impact when it actually occurs. But equally, there wasn't a cash impact when the charge was applied to the income statement uh, to the earnings before. So next we'll have a look at cash flows. So with the exception of 2021, which saw a dip, cash flows from operating activities before changes in operating assets and liabilities, working capital, have grown steadily each year from 2019 to 2023. Adding in movements of, adding in movements in loans and advances to customers, deposits from customers, and other operating assets such as liabilities, the picture is less smooth, with net outflows in 2019, 2021, and 2023 that exceed the inflows in 2020 and 2022. This is largely driven by growth in loans and advances exceeding growth in deposits from customers and cash flows from operations. Net cash flow from investing activities were positive in all of the last 5 years except 2023, when they turned slightly negative. The inflows in 2021 and 2019 and 2020 were driven by the maturity and sale of debt securities exceeding the purchase of such securities, while the inflows in 2021 and 2022 were driven by the consideration received from loan book sales, all the divestments and so on. Net cash flow from financing activities has fluctuated quite a bit over the last 5 years, largely driven by issuance/drawdown and redemption/payment of debt. Dividends have also been a component, with payments made to shareholders in every year except 2020, where they were suspended due to the heightened uncertainty at the outset of the pandemic. There have been quite significant changes in the company's dividend policy over the last 5 years. In 2019, the company had a progressive dividend policy with a payout of 50% of annual earnings. When the dividend was resumed in 2021, the progressive aspect was removed and the payout was lowered to 25%, which is why you can see a significant drop despite net profit being higher. Going forwards, the company has responded to shareholder feedback by reintroducing the progressive dividend policy, but maintaining the payout at 25% in order to preserve capital required for management's medium-term growth ambitions. I would potentially expect it to, once we get to the desired loan book size of 4 billion, when we are seeing those medium-term, if we are hitting those medium-term targets, I would expect to probably see them revert back to 50% payout. I would probably hope so. Once they reach that sustainable level, it doesn't seem necessary to retain such a large amount of the earnings at that point. Combining the cash flows from operating, investment, and financing activities, we can see that cash and cash equivalents have grown from £145 million in 2019 to £400.3 million in 2023. Yeah. So we had net growth in 3 of the last 5 years. All right, so next we'll have a look at management. and then have a look at the executive compensation for said management. Just have a quick think. Right, so David McCready was appointed as CEO on the 5th of January 2021, having previously served on the board as a non-executive director since 17th of December 2019. He worked at Royal Bank of Scotland, RBS, for 20 years, ending in an appointment as CEO of Kroger Personal Finance, a joint venture between RBS and Kroger Company, from 2004 to 2008. He moved to Tesco Personal Finance in 2008 and helped build Tesco Bank, where he then served as an executive director and managing director from 2015 to 2019. David replaced Paul Linham, who had served as CEO since STB's original AIM listing a decade earlier. Rachel Lawrence was appointed as CFO on 23rd of September 2020, after the resignation of the prior CFO, Niraj Kapoor, in 2019. Rachel has previously held senior finance roles at Metro Bank plc, where she was part of the original team that set up the bank. She was also part of the successful IPO of Shawbrook Bank, and immediately prior to joining STB, served as CFO of AIB Group UK plc. Jim Brown was appointed as the new chairman at this year's AGM, replacing Lord Forsyth, who had held the role for the last 10 years. Jim has served in a number of executive roles during his career, including most recently CEO of Sainsbury's Bank, and prior to that, CEO of Future Williams and Glyn, and CEO of Ulster Bank Group. Executive compensation. Executive compensation is pretty standard, consisting of a base salary, pension contribution, annual bonus, and share awards made through a long-term incentive plan, or LTIP. For the year ending 31st of December 2024, the executive compensation is as follows. Base salary. David McCready will receive an annual salary of £689,585, and Rachel Lawrence will receive an annual base salary of £495,000, pro rata from 1st of April 2024, rising from £432,848 the prior year. I wouldn't normally mention the chairman's salary, but it is quite considerable at £237,000, 3 times the basic fee of the other non-execs. Seems pretty high for a company of this size, but maybe the level of regulation plays a hand. This might be a fairly standard thing for banks. Pension. Both executives will receive a pension contribution worth 5% of base salary, in line with the wider employee base. And then the annual bonus. The maximum annual bonus opportunity will be up to 100% of base salary, subject to meeting certain performance requirements, divided into 65% financial and risk metrics and 35% non-financial metrics. The financial metrics will include underlying continuing profit before tax, which is 25%, net interest margin, 10%, operating costs, 10%, capital ratios, 10%, and a cost of risk, 10%. And then, of course, you've got the 35% of non-financial metrics as well to make up the full 100%. Now the LTIP, or long-term incentive plan. So nominal share options valued at up to 100% of base salary will be issued on meeting certain performance targets over a period of 3 years. These targets are as follows: 25% relative total shareholder return measured versus the FTSE small cap, excluding IT index, 25% return on average equity, which is targeting the 14 to 16% target range, in line with their medium-term targets, and 25% growth in diluted earnings per share, um, with 20% to 30% CAGR, the target range. And finally, 25% risk management, which is measured against credit losses, capital levels, etc. The actual bonuses received in 2023 were £283,000 and £183,000 for the CEO and CFO, respectively, representing 41.0% and 42.29% of the maximum payout available. Something else to note with regard to the LTIP share awards is that they're valued based on the share price, which, as I'll cover shortly, is about 50% of book value. It's actually more like 20% of book value now, meaning they understate the true value of the awards quite substantially. In any case, the awards are not unreasonable if they can hit the targets outlined above. Then we've got that's the management and executive compensation covered. So just quickly, we've got a list of substantial shareholders as at 31st of December 2023. And I think quite a few of these have dumped all of their shares since now. So I'm pretty sure Unicorn Asset Management, which had 5.8%, has dumped their shares. I can't remember the others, but I've been seeing quite a few notifications of substantial sell downs, probably possibly Premier Marathon as well, with 5.13%. But yeah, the top two were Fidelity Worldwide Investment at 9.38% and Mr. Stephen A. Cohen at 7.94%. But yeah, as you can see, they are largely institutional investors, with the prior owner, Arbuthnot Banking Group, having sold down its ownership below the point of declaration. So now these figures are going to be uh, quite out of date now when we're looking at the investment outlook and current valuation. So the figures I've got here, for which are based on a share price of £8 a share, it's now something like £3.60 a share. So more than cut it in half from these figures. So with the current share price of circa £8 per share and corresponding market capitalization of £152.6 million, STB currently trades at a price to 5-year average earnings multiple of 5.1x and a price to tangible book value multiple of 0.45x. So we can turn those into about probably 75 million or something or less market capitalization. And that would give us something like 2.5 or less times the 5-year average earnings, and probably like 0.2 or 20% of book value. So incredibly cheap now. Obviously, if you've got big holders, some of it is obviously rational. There's now heightened risks, depending on where the heightened uncertainty, depending on how this vehicle finance stuff goes. If the government and the courts decide to just allow it to completely destroy the industry and kill off all vehicle financing, which again represents 9 out of 10 cars are sold on finance. So basically wipe out the entire auto industry. Then yeah, it's going to be the STB is going to be caught in the fallout of that and will take a very substantial impact and might have to source some new funding. It's certainly going to, at the very least, it will put the brakes on any of their growth ambitions, and there'll be a period of time where they're having to recapitalize themselves, reshore the balance sheet. Um, a possibility of some dilution maybe in there as well. Um, if one method could be to try and raise some new equity, but yeah, we don't know. We don't know exactly what the size of the impact is. So that's your uncertainty. That's your worst case scenario there. Um, Potentially even, I mean, the price now is implying that effectively it'll be wiped out. There's a possibility of it being wiped out, but part of it, the actual risk of that happening, I would say, is in no rational scenario would that happen. But obviously, we are not every humans aren't rational, entirely rational, and there is still a possibility. But yeah, I'm still obviously the fact that I'm still holding the shares. It means that I am leaning towards it, it being unlikely that the impact is going to be anywhere near as large as that. And if it ends up being just the discretionary commission, which is what the original FCA investigation was about, then it's effectively a non-event. It did very minimal impact on the company. Um, and yeah, we're talking 10, 20 million or something like that sort of impact. That's the kind of order of magnitude we're talking, which is something that the bank can easily absorb. Um, and over a period of multiple years as well. So uh, on a per year basis, quite a small thing to it for it to absorb because it didn't do much in the way of um, discretionary commission arrangements. But yeah, I think I've covered them in some depth in another update, which will be a subsequent video. So won't try and cover them too much now. But yeah, so that's the worst case scenario is covered is that there's things I think it's it's quite unlikely that will happen. But obviously, if you have holders like Unicorn Asset Management, for instance, holding 5.8%, decide to liquidate their position in a small cap company, which has had 152.6 million pound market cap at the time before this happened, when it's trading £8 a share. If you take a company like that and try and sell 5.8% of it, and like I've said, there's multiple of these funds that have done that, it's going to absolutely tank the shares because of the lack of liquidity. So you end up with massively exaggerated drops. Maybe I would maybe argue that trading at 50% of or 45% of book value was probably enough of a discount already for this. But obviously, the market disagreed and wanted to flee from the flee from the stock. So you've ended up with this pretty crazy valuation that implies, if you trust the valuation, implies a real possibility of insolvency. That's uh, that's how we've got where we've got. Um, so then, yeah, I've also done a forward valuation, so we can quickly have a look through that. So looking ahead, management has laid out some medium-term targets that align fairly closely with those in the LTIP outlined above. They are as follows: the return on average equity between 14 to 16%, net interest margin greater than 5.5%, and the cost to income ratio of 44 to 46%. So as I was saying about the 45% there on the from the from the 57 point something percent currently or in 2023. CET1 ratio greater than 12% and a loan book of circa £4 billion. The path to achieving these targets was laid out in detail during the Capital Markets Day held in November 2023, but the key determinants were the following. Loan book growth underpins the other targets and requires a significantly lower growth rate than has been seen in the last 3 years, making it a realistic ambition. It is also possible to increase lending to this level more rapidly due to the excess lending capacity created by the Tier 2 notes issued in 2023. A small shift in lending mix from 51% to 55% consumer finance would lead to a net interest margin of 5.7%. The reduction in the cost income ratio would be driven by 17% income growth exceeding 8% cost growth based on 5% annual cost inflation. It's hard to do a precise translation of what a CET1 ratio of 12% would mean in terms of equity, because it's based on total risk exposure rather than the loan book value. But looking back at the last couple of years, the ratio between total risk exposure and net book loan book and the net loan book has been around 0.8, meaning that we could estimate the total risk exposure to be £3.2 billion if the net loan book were £4 billion. With this figure in hand, we can calculate equity to be approximately £384 million at a CET1 ratio of 12%. Then, using a return on equity range of 14 to 16%, we can estimate net profit to be between £53.8 million and £61.4 million. Taking the midpoint of this range of £57.6 million, we get a forward price to earnings multiple of 2.6 times and price to book multiple of 0.4 times. So obviously, you can cut these in half, so it's just over, so maybe 1.2, 1.3 times earnings if they do achieve these midterm targets, and the price to book would be probably 1.17% or something of book value. It's also worth noting that if the current payout, 25% payout were maintained, the dividend yield on this earnings level would be 9.4%, so double that. So that should be 18.8%, or probably a bit more, probably about 20%, based on the current market cap that you could buy it for, the company for. And if they were to actually, imagine if they were to actually raise that back up to 50% payout, you'd be looking at something like 40%. Yeah, so there's an awful lot of upside here, a lot of asymmetry. Certainly, I thought it was an attractive deal at these prices. When you're talking 2.6 times forward earnings based on these midterm targets, which is about a couple of years targets we're talking here, not like 5 years plus, or 5.1 times the current earnings, and being able to buy it for less than half book. I thought that was already pretty cheap, considering the actual loans themselves are pretty high quality. The actual business itself, it's just this risk, this regulatory risk, that is the issue here. So yeah, it's if you take that away, the regulatory risk here, then the asymmetry is it's quite incredible. But even, we're talking downside, if it, let's say it got up, then you can also think about what should it be trading at. Probably should be trading above, if it was able to achieve 15% returns on equity, maybe should be trading a little bit above book value. So yeah, you'd be looking at maybe 5 or 6x at least, or just on the basis of earnings. I mean, if it deserves to trade at 10 times earnings, and or 12 times earnings, let's say, or dividend yield, if it was so that would be a 10x from here on that basis. Or if it was trading on a dividend yield of, let's say, 5%, and the payout was 20%, you've got at least a 4x from here. And then obviously, if they actually were to do the payout of 50%, then yeah, it could be 8 to 10x or whatever from here as well. So, and then you've got actual growth in the business from there, as well as a potential return. But so yeah, an awful lot of upside here. And I think the downside is exaggerated. So I think it is a highly asymmetric bet. So anyway, that brings this to a close. What I'll do in the next episode is I'll have a look at the company update I did. Um, so I've got two. I've got the interim results, which we can have a look at. Um, and then I've got the bit, bit of an overview, some of the fallout, the Vehicle Finance Commission, and then a uh, and then a look at the Q3 trading update. So we're going to have a look at probably bundle those two together into one episode, and that will be the last episode for a while on STB because well, it depends when we next get some results from them. Presume it would probably going to be the full year results next year. So yeah, there'll be some other company, probably Fuller's or Tiny Build. Though I may have already done an update on Tiny Build. I can't remember whether when my last video on them was. Uh, but yeah, we'll have a look at those. But yeah, just a reminder, you'll see some links in the video, but it's very easy. Just firmreturns.com if you want to come and actually read this. These updates are all free. These updates I do on the companies. You can subscribe just in the top right here where it says account for me, but it will say subscribe for you. Or sign up or something. You can go there and you'll get these updates when I send them out into your inbox. You can also, if you actually are interested, I have a very reasonable paid tier, which gives you these full research reports. And I'm aiming for and have achieved so far 2 per year of these. I mean, I've made them particularly long form now, as you can see with this one. It's about 16,000 words, and you've seen through this video series covering it how extensive and detailed I've been with the research on it. You can get these two of these research reports a year for just I have a paid tier priced at £30 per annum, which works out to be £2.50 a month. And in addition to these long form research reports, which effectively you're getting for £15 each, you also get portfolio updates. So whenever I buy or sell something, so the last two were in October. Not been doing I haven't been doing a great deal of buying and selling in the last half of this year, but you get it every time I do. You get it straight on the day that I do it. And then of course you've got these company updates. Yeah, but I think you'll be hard pressed to find research of this depth and hopefully quality for anything like that price from any other newsletter out there. So, and obviously I'm doing that partly because I'm doing it part time, which is why you're only getting two of these long form reports a year. Yeah, hopefully, I mean, it's certainly a price I would be very willing to pay myself. That's what how I've priced it. I've priced it in such a way that it is a price I'd be very happy to pay if someone else I knew was following was doing a newsletter and charged for this kind of level of depth and quality research on companies. I'd be very happy to pay that. In fact, I'd probably be happy to pay about up at least £5. But yeah, I think £2.50 a month or £30 a year is a very reasonable, probably the most reasonable price out there for any newsletter. But yeah, so if you're interested, please consider doing so. Or at least there's no be nice to have the support of that. But obviously, if you're new to this, you're new to firm returns and my research and so on, I'd fully understand you signing up to the free one, doing that for 6 months, a year, whatever, before to actually get some value out of it first. Make sure it's something you're getting is of interest, you're getting the value and so on before you consider doing something like that. Absolutely fine. Or never paying ever, just being just getting the free ones is absolutely fine. Put out plenty of free content through these company these company updates and so on. So so yeah, um, please remember to give this if you're interested in these video series, which as you can see, I've given you content that going into depth on these research reports that you'd have to pay for otherwise. So that please give this video a like, comment anything, add any comments that you have on any of these things, any questions or anything. I'm happy to answer. Very happy when people reach out and via email, which you can do info@firmreturns.com, or direct message me on Twitter or something as well. However you choose to do it. Comments on YouTube, I'll try and respond to all those. Any questions people might have in there. But yeah, subscribe to the YouTube channel for some more videos like this. Yeah, and there's also audio ones as well. If you'd prefer, if you just want to listen to it, got them all on Spotify, etc. If you listen to that. Right, I think that will do it for this episode. And like I say, I will have a be looking at the last couple of updates I've done on STB through my newsletter. So yeah, please go give those a look yourself if you're interested in reading more. But yeah, keep an eye out on your YouTube feed for the next episode. All right.